Good morning, everyone, and thanks for joining this session on an overview of the M&A market and some perspectives around where we may be heading in these unprecedented times. My name is Lyle Wilpon, and I'm the global head of our M&A business. I've had the pleasure of meeting with and working with a number of you over the years, so I'm happy to share my perspectives in the next 15 minutes or so, hoping to allow some time at the end of my presentation for questions you may have. I'm confident you've all been watching the markets closely, but to lay the groundwork for this M&A discussion, I'll review at a high level the market reaction to the COVID pandemic. While we started the year with strong equity markets, there was some uncertainty from geopolitical concerns, trade wars, and pressures from the upcoming election. But investors expected the 11-year bull market to continue. When the pandemic spread globally, we saw equity markets plummet and volatility spike upwards around the world. This included two of the largest one-day drops in market history. And as you know, the resulting impact of reduced travel drove oil prices down and additional stress on the economy. However, we've seen a rebound over the past few weeks, with the S&P 500 now 30% higher than the lows set in March and is trading at about 22 times forward earnings. What you see here on the first slide, COVID market reactions rival or surpass prior financial crises, including Black Monday, the Great Depression, and the 2008 financial crisis. Market volatility calculated by VIX hit near all-time highs, but has settled into a higher than normal level in recent weeks. So what does this mean for M&A markets? At the start of this year, similarly, the economy seemed on track and supportive of a healthy M&A environment. As the pandemic started to spread globally and financial markets were impacted, we started to see unprecedented disruption in M&A activity as well. There were no deals over $1 billion announced the week of April 17th, something we haven't experienced in over 15 years. Mostly we are seeing deals put on hold due to uncertainty around valuation, business models, and access to financing, with other factors as well, which I will get into shortly. That being said, we're seeing some transactions still being completed, and mostly between companies within the same sector or those already in advanced discussions. To drill deeper into the themes we're seeing, and I would expect these will continue to evolve over the year, but we are clearly facing a new M&A environment. M&A activity is being impacted by uncertainty and shelter-in-place restrictions. Let's start with capital preservation. One of the themes we saw early in the crisis was clients focused on balance sheet and conservation of capital. With concerns around accessing capital markets, we saw increases in drawdowns on revolvers, but that behavior is tempered with government stimulus providing liquidity and stability and opening up access to investment-grade new issuance. Next, valuation. Many companies are facing disruption in their business, sourcing, office shutdowns, etc., driving accounting for non-recurring extraordinary expenses. This is creating difficulties in forecasting businesses, models, and thoughtfully conducting valuation analyses. Also, while valuations have recently fallen, creating a good buyer's market, sellers are reluctant to sell at a distressed value. As for operational uncertainty, buyers need to increase focus of their due diligence on target supply chain risk and exposure to customers in highly infected virus regions. Consequently, sellers need to be more flexible on purchase price adjustment mechanisms given the uncertainty and the potential for deterioration in the business. Next, physical lockdowns. With offices and factories in lockdown and significant travel restrictions, the ability to conduct in-person management presentations and appropriate due diligence is certainly challenging. This has been evolving with the onset of virtual meetings and video conferencing. And finally, buyer's remorse. With the uncertainty in the environment, buyers may come to regret their decision to pursue a transaction. Buyers should be insisting on contract protections such as MAC clauses that would address pandemic risks and give them the ability to walk away. I will address this in more detail later on. As mentioned, with uncertainty around long-term performance of businesses, valuations are challenging. While we typically value deals based on multiples of revenues or EBITDA, sellers of public companies will seek higher purchase price premiums and argue that the fundamentals of their business have not changed. This page shows the comparison of purchase price premiums during periods of distressed markets or high volatility to regular markets. Notably, consumer staples show the highest delta, achieving the highest premium during distressed markets. Though buyers pay heftier premiums in order to reach attractive purchase prices, they typically realize better value in terms of purchase price multiples, especially from companies with strong underlying financials. Again, I would point out to the consumer staples bar, which shows a value purchased during distressed markets. While full effect of the impact on acquisition finance is far from clear, I expect to see an increase in equity as a percentage of purchase price. As you can see, going back over the past few market downturns, the evidence suggests that there is a decrease in all cash deals during recessionary periods. Also, stock for stock deals are typically viewed as more favorable given relative consideration. And lastly, we would expect an uptick in all stock transactions in 2020, which will drive public to public and public to private M&A. In the near term, we should expect to see an increase in buyers insisting on the use of protection clauses and additional covenants within M&A agreements. This gives them the ability to walk away if the situation should materially worsen. We are already seeing a number of real-time examples of this in the market today. For example, in the Sycamore Partners Victoria's Secret deal, which was terminated last week without either party paying a fee to the other side. Sycamore had originally agreed to buy a majority stake in Victoria's Secret in February in a deal that valued the company at $1.1 billion, with L Brands retaining a 45% stake. The private equity firm said in a court filing that the steps L Brands had taken to survive the pandemic, including furloughing workers and failing to pay rent, violated terms of the original deal. Days later, L Brands sued to keep their deal intact. Sycamore stated in its press release that, quote, neither party will be required to pay the other a termination fee or other consideration as a result of the mutual decision to terminate the agreement and settle the pending litigation, unquote. L Brands announced plans to spin off Victoria's Secret into a separate company. Several analysts believe that L Brands would have prevailed in court, though this likely would not have been worth the effort nor the cost. Forcing a deal with Sycamore would have made for an uneasy partnership in any case. Within FCR, looking more specifically, we're seeing a fairly wide variance in trends emerge across the various subsectors, depending on the discretionary, non-discretionary nature of the business. The food distribution and retail sectors have remained resilient despite an overall negative downturn across the sector. While we're seeing select M&A activity as well-capitalized buyers continue to complete select transactions and some PE firms provide near-term relief. Until there is more clarity around the severity and length of COVID impact, it's difficult to envision large transformative M&A transactions closing in the near term. However, we are seeing a fair bit of activity where distressed situations are driving activism, lawsuits, and restructuring. Looking forward, we're seeing a number of positive indicators that could drive additional M&A activity this year. At a high level, here are the key themes which I will get into further detail over the next several pages. With record levels of dry powder, I expect sponsors will look to take advantage of low valuations. Well-positioned activists and hedge funds will seek to increase ownership in companies they already own and look to influence business decisions, driving some shareholder activism. Due to the market dislocation, we could see an uptick in public M&A targets, as well-capitalized buyers look to take advantage of current situations. We also anticipate an increase in unsolicited and hostile activity. In terms of consideration, as I mentioned earlier, stock as a form of transaction consideration will likely become more attractive as all cash deals become challenging and boards may be more reluctant to support cash transactions at depressed valuation levels. Drilling deeper into some of these themes mentioned in terms of sponsors, we expect to see an increase in take-private activity. As you can see on this slide, based on what we saw from the financial crisis in 2008, sponsors will likely focus efforts on their portfolio companies and add-ons as a first priority. As a result, we expect to see a reduced number of exits for some period. A difference from the last crisis, however, is that private equity was in a much worse position then. Much less dry powder, credit markets were frozen, so sponsors are likely to be more offensive this time around. And thus we expect to see a lift in sponsor buyouts driving the M&A market going forward. From our active discussions with PE clients, we know their appetite to acquire is high given ample supply of unspent equity, and as debt markets continue to return to normal, we expect to see them be more active. As the economic downturn continues to impact many businesses, an increase in distressed targets will likely create opportunities for activists. Although COVID-19 may prove to be a challenging time to formally launch a campaign, it represents a compelling buying opportunity for future campaigns. That said, the record amounts of dry powder provides a window of opportunity to establish toeholds for future campaigns. To mitigate activism and hostile takeovers, a strong defense tactic for corporations is adopting a shareholder rights plan. Similar to what we saw during the 2008 financial crisis and the dot-com bubble, there's been a dramatic increase in shareholder rights plans, known as poison pills. Since mid-March, there have been approximately 50 poison pills adopted, and the number of adoptions year to date is greater than all of 2019. As it relates to the FC&R sector, we're seeing the same themes around shareholder activism and poison pill adoptions. What you can see on this page are some well-known consumer retail brands who've been subject to recent activism campaigns, such as GNC, where John Y. Tang sent a letter to the board urging GNC to take necessary actions to resolve short-term liquidity issues, and later stated it would begin investigating if the company possibly committed fraud and breached its fiduciary duty. In the case of McDonald's, CTW Investment Group filed a notice urging shareholders to vote against the re-election of 2 directors and expressed concern around the board's handling of a windfall compensation package for former CEO Steve Easterbrook, who was terminated due to corporate policy violation. Rather surprisingly, in the midst of this crisis, we've seen numerous activists gear campaigns to ESG-related issues, such as green initiatives. Examples include Bloomin' Brands, Walmart, and Yum Brands. Consequently, this is driving corporates to seek out protection measures in the form of poison pill adoptions. Again, what you see here are some recent examples of poison pill adoptions in the consumer retail sector. As we look ahead, and on a positive note, we're starting to see some indications pointing to a broader restart of the economy. Beginning of social distancing easing with local and stay-at-home orders phasing out, we expect loosening of restrictions on businesses to provide more foot traffic and the ability to conduct in-person due diligence. Unemployment reduction, where the US unemployment claims recently hit a staggering 33 million the week of May 2nd, had 3.2 million claims and marked the 5th consecutive week that the number of initial claims had fallen. Claims peaked the last week of March with nearly 7 million claims. As the economy continues to reopen, we anticipate unemployment trends will continue to improve as broader business activity increases. As for credit market stabilization, a combination of monetary and fiscal policy has allowed credit markets to grow more stable throughout April. A stable debt market is essential for processes to restart and is necessary for buyers to actively pursue M&A opportunities. And lastly, predictability of and confidence in seller projections. As consumers gradually shift to a more normal purchase behavior, sellers will have greater conviction when estimating their future performance. And buyers will be more inclined to bid for the future with this added credibility. I'd like to highlight a recent transaction on which BMO advised. This past Monday, Clayton, Dubilier & Rice announced an agreement to acquire Radio Systems Corporation, the market-leading provider of innovative pet product solutions. This serves as one of the first new LBO transactions in the consumer space since the COVID-19 shutdown began in March. Financing will serve as one of the first new transactions for a relatively healthy business in the consumer space relative to recent liquidity-driven activity. This deal could mark the beginning of the return of recently postponed LBO activity, particularly for businesses that have navigated the current environment well and were down the path in a sale process pre-COVID. As I mentioned at the outset of this presentation, both the S&P 500 and M&A deal volume dropped faster and more dramatically than in prior crises. The drop in the S&P that we saw at the start of COVID over a few weeks is consistent with the drop during other crises over a full year. And we are already starting to see a rebound with the S&P back up to 13% below all-time highs. Debt markets as well, which were effectively shut down at the start of this crisis, have started back up again, with deals getting done in early April in the high-yield market and loans starting back up about 2 weeks ago. In comparison, during the financial crisis of 2008, markets were effectively shut down after Lehman went under and remained closed for about 3 months. This time around, the faster rebound is largely due to the Fed's actions at the end of March. guaranteeing liquidity in the capital markets all the way through non-investment grade debt. In short, the markets have rebounded in a matter of weeks, and swift policy response from the government has made a much stronger indication this time that hopefully we may even see a V-shaped recovery. As it relates to M&A, we've typically seen M&A activity rebound within 2 to 4 quarters post-crisis. So the big question, will this trend continue, or is it possible M&A will accelerate and become more in line with equity and debt markets? So what can you do to prepare yourselves as you think about your own strategic alternatives, both from a defensive as well as offensive perspective? When we think about defense preparedness, here's our playbook. Given activism is on the rise, thinking through a defense plan would be a good idea at this point. Make sure you're engaging with your shareholder base, and revisiting your shareholders' rights plan would be prudent. Analyzing your balance sheet and figuring out your optimal capital structure. And if you're struggling with liquidity concerns, it may be a good time to be open-minded to a conversation around a strategic investment. And as for being more on the offense, if you have the luxury of excess liquidity, this is a great time to be looking at the market for add-on acquisitions. While we're going through a difficult time, for many businesses, the fundamentals have not changed, and there are good values to be had. Continue to evaluate ongoing auctions and assess opportunities, likely at new terms. It may also be a good idea to revisit discussions you've had in the past. This new environment may prove to be the right time to transact. Some sellers may be facing liquidity constraints and may welcome your approach. Remember, preserve liquidity so that you can act quickly when the right opportunity presents itself. Regardless of which tactic you choose to employ, my team stands ready to help you in any way we can.